Hello friends, welcome to FindMonk, where financial education is free. What if I told you that Warren Buffett's secret weapon wasn't a stock, but a man? Charlie Munger, the brilliant partner behind Berkshire Hathaway, shaped the way Buffett and the world invest. In this video, we break down Munger's top 5 timeless investment principles that could change the way you think about money forever. Chapter 1: Think long-term and avoid activity bias. Why? Because great investments take time to unfold. Look at Coke. Warren Buffett purchased it in 1988. You know how long he held it before selling some shares? For 3 decades. But here's the catch. He didn't start seeing major profits until well into his second decade of ownership. Many investors can't stomach this. They buy and sell constantly. This activity bias makes them miss out on the real gains. To illustrate this point, let's look at 2 graphs. The first shows a stock compounding at 10% annually over 30 years. Just think about it. So here's a question for you. Are you guilty of activity bias? Have you been buying and selling a lot lately? Share your thoughts in the comments. We'd love to hear from you. And while you're at it, hit that thumbs up button. It helps us keep making great videos for you. Chapter 2: Know your circle of competence. Let me tell you a story. Imagine 2 friends, Tom and Jerry, who are passionate about investing. One day they come across a brilliant idea. Tom wants to invest in Apple, but Jerry tells him, "Hold up, buddy. That's not our area of expertise. We haven't cracked open a tech company in years. Let's stick to what we know best, like consumer goods." So Jerry decides to invest in a company called Example Co., which sells soap and shampoo. A year passes and Tom's Apple investment skyrockets, while Jerry's Example Co. stays flat. Disappointed, Jerry wonders why he didn't listen to Tom. Here's the thing though, Tom would have felt the same way if the situation had reversed. The moral of the story is that we can't be experts at everything. Sometimes our emotions get the better of us, like fear or greed. When we don't understand something, we should say, "I do you want to know," instead of falling into the trap of "I do you want to know what I do you want to know." Basically, Munger's saying that you shouldn't throw your money at things you don't understand, just because everyone else is doing it. He's talking about something called FOMO, which stands for fear of missing out. We've all been there. We see other people making money and we feel like we need to join in too. But that's not always the best idea. Instead, Munger suggests that you should stay within your circle of competence, which means only investing in stuff that you know really well. Think of it like a game of Monopoly. You wouldn't invest in a property just because it looks pretty, would you? No. You'd buy properties that make sense for your strategy. Same thing with investing. Stick to what you're good at and you'll do much better. Here's a tip for you. Draw a literal circle and write your knowledge in the middle. Everything inside that circle is fair game. Everything outside, proceed with caution. Chapter 3: Use mental models to understand reality. Imagine this. You're standing in front of a huge building with lots of doors, each representing a different area of expertise like psychology, economics, math, and history. Munger is saying that you need to open the doors to these rooms and bring in as much knowledge as possible. Why? Because knowing a little bit about many things can be helpful, but it's not enough to make smart decisions. The real trick is figuring out how these ideas fit together. It's like solving a puzzle. Each new piece you learn adds to the picture, helping you understand things better. Once you've gathered enough pieces, suddenly you can see the whole picture. That's how mental models help you understand reality better. For example, imagine you're thinking about buying a new iPhone. You might think, "Wow, it's so cool." But then you remember something you learned about human psychology. People tend to adapt to new things quickly. You might think, "Hey, maybe I don't need the latest iPhone after all. I'll wait and see what the next model looks like." Using this mental model helps you save money. Another example is the concept of opportunity cost. Let's say you have $100 and you want to buy either a fancy dinner or a book. Your money is limited, so choosing one means you can't spend it on the other. The opportunity cost is the value of the next best alternative that you give up when you make a choice. For instance, if you spend all $100 on dinner, the opportunity cost is the book you could have bought. So opportunity cost helps you make better choices by considering what you're giving up by selecting one option over another. Similarly, incentive bias plays a role in how businesses operate. Let's say a salesperson gets paid based on how many products they sell. Their interests, also known as incentives, push them to sell as much as possible. But what if the product isn't good? To avoid this, businesses often put checks in place. For example, they might ask customers for feedback or monitor employee behavior. These are ways to counteract the negative effects of incentive bias and ensure that everyone, from salespeople to executives, acts in a way that benefits both the company and its customers. By understanding these concepts, you can apply them to various aspects of your life, whether it's personal finance, career decisions, or business operations. It's all about using knowledge wisely to make better choices. Here's a tip for you. Think of a business decision as a giant puzzle. Each mental model, like psychology, economics, math, etc., is a piece of the puzzle. Putting them together gives you the full picture. Chapter 4: Avoid stupidity instead of chasing brilliance. Picture this. 2 friends, Alex and Ben, are looking for shortcuts to success. Alex thinks the trick is to be super smart, always finding those brilliant ideas that seem too good to be true. On the other hand, Ben believes in playing it safe, avoiding big mistakes instead of chasing greatness. One day, Alex sees a stock that looks like it could double in value. He dives right in without much thought. Meanwhile, Ben ignores it, sticking with companies he understands. Years pass and guess what? Alex's big win never came. His brilliant idea turned out to be a dud. As for Ben, he may not have made huge headlines, but his simple approach paid off. He built a solid portfolio of stable companies that grew steadily over time. In fact, studies show that the top 20% of fund managers with the best track records have done so not because they but because they've avoided big losses. Munger is suggesting that being consistently not stupid is a winning strategy. But how exactly do you do that? Create a don't do these checklists. Think of it as your shield against stupidity. Here are 3 common mistakes to add to your list. Overtrading, it's like gambling. Frequent trading seems exciting, but it eats up your profits with fees and taxes. High debt. Companies with tons of debt are risky. They might fail, leaving you with nothing. No moat. Imagine owning a part of a castle without a protective moat. Not a good idea, right? A strong moat protects a business and keeps competition out. Without it, your investment might be in danger. Chapter 5. Patience plus discipline equals outperformance. Let's play a quick game. I've got 3 words for you. Warren Buffett, Berkshire. Can you name that company? Boom, right? Answer B. These letters hold serious weight in the investment world. They represent Warren Buffett's company, Berkshire Hathaway. But what makes these letters so valuable? The answer lies in the power of patience and discipline. You see BRKA and BRKBR special, they're like rare gems that appreciate in value over time. But here's the twist. While many investors dream of owning these shares, few do. Why? Because these gems don't sparkle overnight. They reward those who wait for the right moment and strike when the time is just right. It's not about luck. It's about being prepared. When the chance to earn a piece of BRK comes along, they're ready to snap it up. And that's when the magic happens. After buying, they hold on tight, keeping their investments safe and letting it grow. This approach has paid off big time. Over the years, they've turned their initial investment into a fortune. Munger's words echo this philosophy. He says, the wise ones bet heavily when the world offers them that opportunity. They bet big when they have the odds. And the rest of the time, they don't. But here's the secret sauce. The real profit isn't just in buying and holding. It's in waiting for the perfect opportunity to buy. It's a balancing act between patience and discipline. Patience to wait for the right moment and discipline to stick to the plan. And when you master this, that's when you become an investment legend. Here's a tip for you. Think of investing as a cycle. First, you wait patiently for the right opportunity. Then you act by making a smart purchase. Next, you hold on to your investment, keeping it safe and secure. And finally, once it's time, you consider selling, and then you wait for the next opportunity. And the cycle begins again. And there you have it. Charlie Munger's wisdom in 5 easy-to-understand parts. Remember, the most important thing is to avoid stupidity. That's what separates the legends from the rest. Now it's your turn. Which tip resonated with you the most? And have you tried applying any of them to your own investments? Share your thoughts in the comments. We'd love to hear from you. And if you found this video helpful, please give us a like and subscribe. Until next time, keep investing wisely and remember, consistency is key.